Your loans are going to get done quickly if you are on top of your stuff and you provide them everything that you need up front. In this video, I'm going to show you how to calculate rental income off of a Schedule E from the tax return, a net rental income calculation. And if you're a borrower or somebody that's looking to purchase and you're trying to figure out how this is going to fit into the grand scheme of things, I'm going to show you exactly how an underwriter and Fannie Mae and Freddie Mac are going to calculate the rental income on your rental property. So stick around. I'm going to show you some cool stuff. It's a quick, down and dirty, easy calculation. I'm going to show you how it's done right now. All right, so the first place that we're going to check always when we have any of these situations is the Fannie Mae selling guide. And that's where we're at right now. So the selling guide gives us all the information we need about anything. Now, Freddie Mac has some different guidelines for different things. Rental income is not one of them. So if you're looking at an alternative loan or an alternative to send your loan to, you can always look at Freddie Mac because they're a little bit more lenient in some areas. Fannie Mae is more lenient in some areas. So this is the rental income sheet for Fannie Mae, and it's pretty clear. It gives you everything that you need to know about how to qualify rental income. Properties, eligible properties, ineligible. It goes down and gives you other guides, policies that are associated with rental properties. So this is very, it's a lot. There's a lot of information in here. So we aren't going to go through all of this, but it gives you things like let's document the rental income from the subject property, whether or not the borrower has had a history of receiving rental income. So if they have had a history and it's a refinance, you're going to follow this guidance. And you're going to use a specific form and all that. If they have no history and it's a purchase, you're going to follow this guidance. So you always want to check Fannie Mae and follow those guidelines. So what Fannie Mae says is that you are going to be using Form 1007 or Form 1025. So 1007, that's what you're going to get off of the appraisal. So this is the calculator that you're going to use right here. So very simple. What we'll do is we're going to pull in the 1040. So this is the 1040 from the client. So this is the Schedule E. And the things that you want to look at in the Schedule E, you want to take a look at the fair rental days, which is going to be up here. So it's associated per property, right? So this person only has one rental property, and there's 365 fair rental days. So when we come into this calculator, this is Fannie Mae's rental income calculator. The first question is, how many months was the property in service? So we divide 365 by 30 days, it gives you 12 months. If it's been less months, it's going to automatically calculate for you the rental income, the net rental income. So the cool thing about the way that Fannie Mae has laid this form out is it follows the Schedule E pretty much to the T. So the first thing you're going to do is you're going to take the rents received, which is $40,800 in this particular instance, and I've already filled this out. You're going to take away the total expenses. So where do we find the total expenses? Down at the bottom, line number 20. So 20 says there's $24,088 in total expenses. So we put that in there. And then we add back in some of the expenses. So if you're looking at qualifying for a mortgage in the future, the one thing that you can control is how much you depreciate from the property up to what the IRS allows you to depreciate. So we're going to add depreciation back in. But first, we're going to start, remember, at the top of the tax return. And so on line 9, it's insurance. That's the first thing that we can add back in. And then we're going to add back in this mortgage interest to banks. So we're going to do line 9, 12. Repairs, we're going to get to that in a second. We can add back in taxes and depreciation. So let's come over here and let's look to see what our list of items includes. So we're adding back the insurance, the mortgage interest, taxes, homeowners association dues. If this was a townhome or a PUD or there was some kind of road maintenance fee, you're going to find it listed in other. So in number 19. So anytime you see any other or grouped expense, whether it's rental income or, self-employment income, you're going to want to find that in the tax return and see what it is. So if this had other listed in there and it was a condo or a townhome, we know that it's going to list the association dues in there. So we would go find that item in the tax return, and then we would come back into our spreadsheet and we would add that depreciation expense or the homeowners association dues back in. Depreciation or depletion, we add that back in And why is that? Well, it's not a real expense. It's a paper expense. So it's not a cost for the property, right? One-time extraordinary expense. Now, this is something that you'll have to check in the guidelines and track down to see exactly what you're going to need to provide as proof. Typically, it's going to be receipts and it's going to be large items. So the AC failed, the furnace failed, they had to replace the roof, the siding, painting, things like that, like major one-time expenses that aren't going to continue because it's not an ongoing monthly expense for the property or ongoing annual expense, right? And so you would add that back in. So this client, let's look to see on the 1040, they had $12,750 in repairs. So we want to add that back in this area. So that gives us our adjusted rental income for the year is $34,730. Now we're not done there. We don't stop at that point. Remember, enter the number of months the property was in service, 12. Again, we got that from the top up here in the fair market rental days, fair rental days, I should say, 12. So that gives us an adjusted monthly rental income of $2,894. So we use arrive here. So in our loan origination system, we've got here gross monthly rental income of $2,894. Now, we don't give this a discount of 75% like you would if it was unleased or newly acquired. You don't do that with this type of calculation because this is a true net rental income calculation. So you give them 100% credit of that prior to hitting them for the principal, interest, taxes, and insurance, right? So when we come back in here, if we're looking back at our spreadsheet, so that number matches, and then you're going to get a copy of the mortgage statement, the homeowner's insurance, and then you're going to find the property taxes for the client, even if they have impounds on the loan, because you want to make sure that their property taxes haven't increased and maybe their impound account is not calculating correctly. So don't just trust the mortgage statement when it gives you impounds. Don't trust that on the taxes and the insurance. You have to verify. That's your legwork that you have to do. So you're going to get a copy of the mortgage statement. You're going to get a copy of the homeowner's insurance declarations page, and you're going to take that and you're going to divide the total annual premium by 12, and you're going to find the property tax. You can do that at the county. You can pull, most every single county now has records of what the property taxes are for a specific property. I use First American Title Company. They have a system called Ignite. You can get it through your title officer. You can ask them if they have like a portal that you can use. I don't know, we have like 1,000 records that we can pull per month without there being a cost. And so the cool thing about that is you pull your property profile, you've got your property tax, your ownership on the property, when they purchased it, how much they purchased it for, when the house was built, how big it is, what the zoning is. All of those things you're going to need for every single loan that you do. Let's say that we get the mortgage statement and we verified that the total payment is $2,000 a month. What that means is that we have our net rental income, or our adjusted monthly rental income. We subtract the total expense, pity, and if there's an association, we get a copy of the homeowners association dues. And all of those things the underwriter is going to ask for. So the way that you expedite your loan is you get the mortgage statement, the homeowners insurance, the property tax, the homeowners association dues up front. And when you submit that loan to underwriting, guess what? They won't have a question about it. It's going to be all there for them. And so when they push your approval, there's not going to be one question about this property. And you want to get a copy of the lease agreement as well. Now, you're also going to follow your Fannie Mae or Freddie Mac findings. It's going to tell you whether or not you need to provide that lease agreement. Let's say the payment's $2,000. That means our net rental income is $894. We've got the total expenses $2,000. Our net rental income is down here. It's $894 a month. This net rental income, remember, this gross amount, this $2,894, offsets this entire payment completely. And so this is positive net rental cash flow. It goes into the expense ratio for the client. So that's it. Simple as that. That's how you go through and qualify rental income. There's further stuff on this sheet here. This is a fantastic spreadsheet, and I will put the links in the comment section, and then that way you can access them for the selling guide and also for the net rent spreadsheet as well. Comment, let us know what you think about this. Let us know if you run into any issues with underwriting. This is what you send in. I like to send this in with my file just to show the underwriter that, hey, you know what, we're doing our homework. They're going to do their own calculation anyways, but it's nice to add in the file. So hit us up. We're here to help. Thanks for watching. Again, I'm Jesse at True Blue Lending.